Microsoft just added roughly $450 billion in market value in a single trading session. And this earnings report explains why. In Q4 fiscal 2026, Microsoft delivered $90 billion in revenue, up 18% year over year. The biggest growth engine was Intelligent Cloud, generating $39.3 billion, while productivity and business processes contributed another $37.8 billion. But the real surprise was not just the growth. Microsoft produced $60.5 billion in gross profit, with a 67% gross margin, even as the company continues pouring enormous amounts of capital into artificial intelligence infrastructure. Operating expenses came in at $19.9 billion, including $10 billion in research and development. Even after that level of investment, operating income reached $40.6 billion, giving Microsoft an operating margin of roughly 45%. Net income finished at $35.8 billion, equal to a 40% net margin, and non-GAAP earnings per share came in at $4.74, comfortably ahead of Wall Street's $4.24 estimate. That is the key takeaway from this quarter. Microsoft is investing aggressively in artificial intelligence without sacrificing earnings power. And when we look inside that $90 billion of revenue, it becomes clear where the next phase of growth is really coming from. So where exactly does that $90 billion come from? Productivity and business processes remains one of Microsoft's largest cash-generating businesses. Microsoft 365 and the broader business software portfolio provide most of the segment revenue, while LinkedIn contributes roughly $5.2 billion and Dynamics 365 adds another $2.4 billion. But the strongest momentum is clearly coming from cloud. Azure, Windows Server, and related services generated roughly $37.1 billion, growing more than 30%. More personal computing tells a different story. Windows, devices, and Xbox hardware remain under pressure, while Bing and search advertising continue to improve. And this is one of the most important changes inside Microsoft. Windows is no longer the center of the investment story. Cloud, artificial intelligence, enterprise software, and recurring services are taking over that role. And you can see that transition clearly in the long-term revenue mix. Over the period shown here, Microsoft's quarterly revenue has climbed from roughly $56.5 billion to $90 billion. But the more interesting story is happening underneath the headline number. Intelligent Cloud is becoming a larger part of Microsoft's overall business, while more personal computing is becoming relatively less important. That shift also changes the margin profile. Productivity and business processes remains an extremely profitable business. But Intelligent Cloud margins have moved lower as Microsoft spends aggressively on graphics processors, networking equipment, data centers, and artificial intelligence capacity. That does not necessarily mean Azure is becoming a weaker business. In many ways, it means the opposite. Demand is growing so quickly that Microsoft is spending heavily just to keep up with it. So the question is no longer whether Azure has demand. The question is whether Microsoft can build capacity fast enough and monetize that capacity before depreciation catches up. That becomes even clearer when we look at the three business segments individually. Start with productivity and business processes. Revenue reached $37.8 billion, up 14%. But the most important number here is 30 million. That is how many paid Microsoft 365 Copilot users the company now has. At roughly $30 per user per month, 30 million paid seats represent more than $10 billion in potential annualized subscription revenue. And that is before Microsoft fully monetizes higher-value agentic artificial intelligence products. LinkedIn continues to expand. Dynamics is growing at a double-digit rate. And GitHub Copilot is moving toward more consumption-based pricing. In other words, Microsoft is layering artificial intelligence monetization across products that already have enormous installed user bases. Now, move to Intelligent Cloud. Azure and other cloud services grew roughly 43%, or 44% in constant currency. Segment revenue reached $39.3 billion. And Microsoft's artificial intelligence business has now surpassed a $37 billion annual revenue run rate. That is an important milestone because artificial intelligence is no longer just a future narrative. It is already becoming a meaningful revenue stream. Finally, there is more personal computing. This is no longer the growth engine Microsoft once depended on, but the revenue mix is improving. Search advertising, services, and recurring content are becoming more important, while hardware contributes less. Microsoft is gradually turning this segment from a product cycle business into a service-driven business. And nowhere is that strategy more powerful than inside Microsoft 365. Microsoft 365 may be one of the strongest distribution platforms in enterprise software. Commercial seats have expanded from roughly 311 million to 464 million. Consumer subscriptions have grown from around 54 million to 95 million. But once again, the number to watch is Copilot. Microsoft 365 Copilot has now crossed 30 million paid seats, and the opportunity is much larger than that number initially suggests. Microsoft already has well over 400 million commercial users, so Copilot is still penetrating only a relatively small portion of the installed base. That changes the economics dramatically. Microsoft does not need to acquire hundreds of millions of new customers to build a massive artificial intelligence business. It can sell more artificial intelligence to customers it already serves. That is one of the strongest distribution advantages in the industry. And LinkedIn gives Microsoft another platform with similar economics. LinkedIn has quietly become one of Microsoft's most strategically valuable assets. The United States remains its largest market with roughly 261 million users, followed by India and Brazil. But the country-by-country numbers are not the real story. The bigger story is scale. LinkedIn's user base has expanded from roughly 660 million to 1.36 billion. At the same time, revenue has grown much faster than the user base. And that gap is exactly what investors should care about. It means LinkedIn is not simply adding accounts. It is monetizing each user more effectively. Premium subscriptions, recruiting tools, advertising, enterprise services, and artificial intelligence features are all increasing the economic value of the network. So Microsoft now owns a professional platform with more than 1 billion users, and that platform is becoming more valuable per user over time. A similar ecosystem advantage shows up inside Dynamics 365. Microsoft is not the market leader in either customer relationship management or enterprise resource planning. Salesforce remains much larger in customer relationship management. Oracle and SAP remain major competitors in enterprise resource planning. But that is exactly what makes Dynamics interesting. Microsoft currently holds only around 4% of the customer relationship management market and slightly more than 3% of enterprise resource planning. That means the runway remains substantial. Both markets are already worth more than $80 billion annually, and both are expected to expand significantly over the coming years. Microsoft, therefore, does not need to dominate either category to create meaningful growth. And Dynamics has one major advantage many standalone competitors cannot replicate. Microsoft can bundle it with Azure, Microsoft 365, Teams, security products, data platforms, and Copilot. That creates an enterprise ecosystem in which every product can reinforce another. And that advantage becomes even more powerful when we zoom out to the global cloud market. Amazon Web Services still leads global cloud infrastructure with roughly 28% market share. Microsoft Azure holds approximately 20%. Google Cloud is around 15%. But the trend matters more than the snapshot. Amazon's share has gradually moved lower over the past several years. Azure has moved higher. Google Cloud has gained share as well. And total cloud infrastructure revenue reached approximately $143 billion in the latest quarter, up around 44% year over year. That is the key point. This market is expanding so quickly that Microsoft does not necessarily need to overtake Amazon Web Services to create enormous value. Azure can remain number 2 and still become one of the largest technology businesses in the world. And artificial intelligence could accelerate that expansion even further. But cloud is not the only market where artificial intelligence could help Microsoft gain share. Search may be the more surprising opportunity. Microsoft is rarely mentioned alongside Meta or Alphabet when investors talk about digital advertising, but the business is already meaningful. Bing, LinkedIn, and Microsoft's other advertising properties together represent roughly $19 billion in advertising revenue in the figures shown here. That is still far below Meta or Alphabet. But Bing is showing something we have not seen for a long time: market share momentum. After falling to roughly 2.4% at its low point, Bing's global search share has recovered to approximately 4.5%. artificial intelligence may be helping bring users back into Microsoft's search ecosystem. And Microsoft does not need to defeat Google for this to matter financially. In a digital advertising market projected to approach $1.27 trillion by 2029, gaining even a few additional points of search share could translate into billions of dollars of incremental revenue. And there is another Microsoft business that has changed dramatically over the past few years: gaming. Microsoft's gaming strategy today looks very different from the traditional Xbox model. Historically, gaming was closely tied to console cycles. Sell more Xbox hardware, then sell more games. That model is fading. The acquisition of ZeniMax expanded Microsoft's content library. But the real transformation came with the $75.4 billion acquisition of Activision Blizzard. After that deal closed, Microsoft's gaming revenue moved onto a structurally higher base. Quarterly revenue now frequently sits around the $5 billion to $6 billion range. But the most important part of the chart is the mix. Content and services now dwarf hardware. That tells us Microsoft is no longer betting primarily on selling more consoles. It is betting on subscriptions, intellectual property, digital content, engagement, and recurring services. In other words, Microsoft is trying to turn gaming into the same kind of recurring revenue ecosystem it has already built in enterprise software. And that brings us to the biggest question in the entire Microsoft story. How much infrastructure does the company need to support all of this growth? Microsoft currently has approximately $678 billion in remaining performance obligations, contracted revenue that has not yet been recognized. About 30% of that amount is expected to convert into revenue within the next 12 months. That distinction matters. Microsoft is not simply building artificial intelligence infrastructure and hoping demand eventually appears. A massive amount of demand is already contracted. The challenge is supplying it. Capital expenditures could approach $255 billion to $260 billion in fiscal 2027 under the long-term projections presented here. And once hundreds of billions of dollars of servers and data centers are placed into service, another cost begins to build: depreciation. This is what some analysts refer to as the depreciation wall. The cash may leave the company today, but the accounting expense can continue hitting earnings for years. And money is not even the only bottleneck. Microsoft needs advanced chips. It needs packaging capacity. It needs semiconductor manufacturing equipment. It needs power. It needs land. And it needs data centers connected to the grid fast enough to turn demand into revenue. That is why the next phase of the artificial intelligence race could become increasingly physical. Microsoft is also trying to control more of the technology stack itself. Its Maya artificial intelligence accelerator and COBOL processor are designed to reduce dependence on outside suppliers and potentially improve infrastructure economics. At the same time, Microsoft is shifting more artificial intelligence products toward consumption-based pricing. The strategy is clear: own more of the stack, capture more of the economics, and monetize every additional unit of computing demand. Which raises an even bigger question: what can Microsoft look like by 2030 if this strategy actually works? Microsoft has discussed a path toward at least $500 billion in annual revenue by 2030. Some more aggressive scenarios go much further, towards $700 billion to $800 billion. The bull case scenario shown here even places Microsoft's stock price at $1,777. But that number should not be the main focus. The more useful question is, what would have to become true for Microsoft to justify that kind of scale? First, Copilot adoption would need to expand well beyond today's 30 million paid users. Second, agentic artificial intelligence would need to create much higher value enterprise workloads. Third, Azure would need to remain one of the primary infrastructure platforms for artificial intelligence inference. And finally, Microsoft would need to manage the physical constraints behind all of it: chips, power, data centers, and depreciation. The framework shown here also highlights longer-term power agreements, custom silicon, artificial intelligence security, gaming, and new search distribution opportunities. Put those pieces together, and Microsoft's strategy begins to look much bigger than cloud computing. The company is attempting to vertically integrate the artificial intelligence economy, from electricity and data centers, to chips and cloud infrastructure, to Copilot, security, business applications, search, and consumer software. If it works, Microsoft does not simply participate in artificial intelligence. It captures revenue across multiple layers of the stack. but building that future is expensive. So the next place to look is where Microsoft is actually spending today. Microsoft's operating expense structure tells us exactly where management is placing its bets. Research and development spending reached $10 billion in the latest quarter. Sales and marketing came in at $7.6 billion. General and administrative expenses were only $2.3 billion. The important point is not simply that expenses are rising. It is where the incremental spending is going. Research and development is growing much faster than administrative overhead. That is a strong signal that Microsoft is directing more resources toward engineering, artificial intelligence, infrastructure software, and product development rather than simply expanding corporate overhead. For a company already operating at Microsoft scale, that is significant. It suggests management still sees artificial intelligence as a major platform shift, not a mature market to be harvested. And so far, that spending has not broken the income statement. Microsoft's quarterly revenue has grown from roughly $49 billion to $90 billion over the period shown here. Net income has more than doubled. And despite enormous infrastructure spending, net margins have generally remained in the mid to high 30% range. The latest quarter sits around 40%. There was one unusually strong period when the margin temporarily reached 47%, largely because of investment-related gains. That should not be treated as the normal earnings base. What matters more is what happens after those one-time effects fade. And Microsoft is still producing extraordinary profitability. That is one reason investors have been willing to tolerate the company's rising infrastructure budget. So far, Microsoft has not been forced to choose between growth and profitability. It is delivering both. And there is another pattern Wall Street has clearly noticed. Microsoft keeps beating expectations. Microsoft has now produced a long streak of quarterly revenue results that either met or exceeded Wall Street expectations. There is no reason to read every quarter individually. The pattern is what matters. In Q4 fiscal 2026, Microsoft reported $90 billion in revenue compared with an estimate of roughly $87.6 billion. That is a beat of about 2.7%. And current consensus estimates suggest Microsoft could move beyond $100 billion in quarterly revenue during fiscal 2027. Think about the scale of that for a moment. Microsoft is already generating $90 billion every 3 months. Yet Wall Street still expects meaningful growth from here. Very few companies in history have been able to compound at this rate from such a massive revenue base. And the earnings story may be even stronger. Microsoft reported non-GAAP earnings per share of $4.74 in Q4 fiscal 2026. Wall Street expected approximately $4.24. That is an upside surprise of roughly 11.8%. Again, the important point is not to walk through every quarterly number. It is the trend. Microsoft has consistently demonstrated an ability to convert revenue growth into earnings growth more efficiently than analysts expected. That means operating leverage is still working even while capital spending accelerates. Consensus estimates now point toward quarterly earnings per share moving above $5 by the end of fiscal 2027. If Microsoft can continue expanding earnings while simultaneously funding one of the largest infrastructure buildouts in corporate history, that would be a powerful argument for the long-term bull case. Which brings us to the final question. What does Wall Street think the stock is worth from here? Based on the data shown here, Microsoft's average 12-month analyst price target is approximately $563.87. That represents roughly 12.8% upside from a share price near $500. But the range of outcomes is wide. The highest forecast reaches $870. The lowest sits near $400. So there is clearly disagreement on valuation. But there is much less disagreement on the direction of the business. Out of 64 analyst ratings shown here, 61 are either buy or strong buy, while only 3 are hold. There are no sell ratings in the data set. Of course, analyst ratings are not guarantees, and a great business can still become an expensive stock. But the bullish case ultimately comes down to 2 questions. Can Azure sustain strong growth? And can Microsoft convert its $678 billion contracted backlog into revenue fast enough to justify the infrastructure being built today? If the answer to both remains yes, Microsoft may still be in the early stages of a much larger transformation. So the real question for Microsoft is simple. Can it monetize artificial intelligence faster than the cost of building it? So far, the numbers say yes. If Microsoft can keep that balance, this may be only the beginning of its artificial intelligence transformation. Thanks for watching. If you enjoyed the breakdown, like, subscribe, and let me know which company you want to see next. This video is for informational purposes only and is not investment advice.